Welcome back. You're watching Startup Street. Now, alternative credit fund Blacksoil has invested $30 million or about 250 crore rupees across 17 deals in just the first quarter of this financial year amid the ongoing funding winter for startups. Its assets under management grew 50% year on year. Blacksoil also doubled its deal closure in the quarter compared to the same period last year and was able to successfully exit 5 deals. Joining me now to talk about the investor sentiment and the outlook on deals for the year ahead is Ankur Bansal, the co-founder and director at Blacksoil. Ankur, welcome to Startup Street. Thank you for your time here. If you could start by giving us a sense of how the first quarter panned out, because you've doubled your deal closure. Any notable names that you could share, and what's really driving this kind of momentum despite a broader slowdown in funding?
Yeah, thanks for having me over. I think, the Q1 was a surprise for us as well. I think the quality of deals that we're seeing today has only increased over a period of time because as you rightly mentioned, the funding winter is going on. So more people are looking for sources of capital beyond equity. And of course, being equity not being the right way to come in, it's becoming difficult for people to raise capital. So debt becomes a good source of capital to get without having to get into the pricing conversation, which people today want to avoid. Because of that, it's almost because of the bear market that we're seeing today, you can pick and choose the kind of transactions you're looking to do. And obviously, one has to be very mindful of the overall environment, right? Many companies are still struggling to get their unit economics correct. Many companies want to become EBITDA positive, but it's not easy to reach that stage. With keeping all this in mind, with our track record of doing this business for over 7 years, sort of has given us a good vantage point of the kind of transactions we want to work with, the kind of companies we want to back, and the kind of companies that we believe will continue to do well despite the funding winter. So because obviously the markets have grown well from a debt perspective, you get enough opportunities out there. And we have been trying to focus on high quality transactions, trying to do our deep due diligence before we trying to close any kind of transaction to avoid any kind of corporate governance issues that we have seen. So what we have seen is today, growth stage companies like Tutsi, something is one of them we funded. We worked with some of the SaaS companies like Mosaic. We have done a fintech company like Kaleidofin. We have done a healthcare company like Genworks. So there's a lot of mixed bag from a sector perspective. We have not gone deep into one sector alone. And we like to keep a very diversified portfolio from a risk perspective, which ensures that we are sort of hedging our bets and at the same time looking at companies which we believe have obviously a very bright future.
Ankur, if I could just request you to briefly answer us, because we have little time left. $30 million in the first quarter, but this is lower than what you did last year. Has the average ticket size of the deal also fallen? And are you writing smaller checks, being more conservative in the environment?
So yeah, the average ticket size has come down for this quarter. It's not by design specifically. Sometimes the kind of transaction that comes to your way, you decide the kind of exposure you want to take. So yes, the average ticket size has come down. But if I see on quarter basis, actually we have grown more than 20%, I think, from last year alone. And our AUM has also grown. So from a business perspective, actually quite well considering the environment.
All right. What's the larger investment strategy? The sectors that you spoke about, they're across deep tech, healthcare, fintech, and whatnot. Are there certain themes that are playing out that are showing more promise?
I think we are sector agnostic, so we don't take a sector call specifically. It's a more of a bottoms-up approach. But there are certain sectors that we typically try to avoid. Businesses have not yet figured out their product market fit or got some kind of attraction which sort of shows there's a good sustainability in the business model. So some of the B2B e-commerce businesses or companies which are in the high-burn space here sort of completely avoided. And trying to work with either relatively low-burn companies or where there is a EBITDA positivity happening possibly in the next 9 to 12 months.
And, you've had 5 exits in the first quarter alone. Which ones were they, and what is lined up in terms of exits for the year ahead?
So being a debt structure, that is one of the benefits of a product, right? Because you're not waiting for the right equity valuation to get an exit. So these are all repayments which are supposed to be due over a period of time. That ensures that your risk also gets getting diversified because your capital is coming back on a regular basis. So one of the deals that we exited was a deal where Oliva, which is a dermatology chain, got capital from Kedara. That was one of the exits we made. A couple of the other transactions were just fintech companies which sort of paid down their loan. One was a company called WebEngage, which had raised some, I think, Series C some time ago. So that loan also had completely come to a close.
Where does your current AUM assets under management stand at? You said there was a 50% kind of growth that you saw compared to last year. What is the current figure? What's the target for the close of the year?
So we are today at around 1,200 crores of AUM. We want to touch, I would say, close to 1,500 crores by the end of the financial year.
All right. Before we let you go, any prominent trends you could outline for us, since you're looking at companies across segments, whether it is valuation markdowns, more debt-focused deals, which is something that you focus on as well, because equity remains tough in this environment.
So we are seeing that promising companies are stitching the equity together. Existing companies are coming and supporting their winners where they think there is a very strong promise. Debt is obviously coming, but it's very difficult to come by if there is a problem, if the company has a runway less than 12 months today. And even M&As, we have not seen that many happen. I think today everybody's focused on their own house and trying to acquire more businesses. Even strategics, we have not seen too much of action happening on that front. But if I take a more of a 12-month view from now, and as the Zepto founder was mentioning as well on the show earlier today, I think the IPO markets are going to be very bright for a lot of the companies who are going to come out of this entire funding winter, because they're going to be very strong, they're going to be lean. They are going to be interesting business models with the capital markets looking for. And there could be very viable exits for a lot of the VC investors and private equity investors from the IPO market. So I'm quite bullish that we'll see a very huge cohort of companies coming out of this entire funding winter, because the innovation is not slowing down. We have seen our portfolio raise this quarter alone more than $60 million of equity. We have seen our portfolio grow 20% year on year, despite the kind of rate that we are seeing. So I think that if this trend continues, a lot of them will be ready for IPOs 2 to 3 years down the line, and our capital markets, as you know, is buzzing enough, looking for good quality paper.
All right, Ankur, on that positive note, thank you very much for your time here on CNBC-TV18.
Thank you. Thanks for having me over. Thank you.
All right, moving on.